afternoon. Today I want to deliver a guest lecture. First, I want to introduce myself. This is Dr.A.Sreenivasulu, Assistant Professor, Department of MBA, Kakarapati Bhavanarana College, Autonomous, Vijayawada. So today I want to deliver a topic on definition of accounting and accounting concepts as well as the accounting conventions. So the exact meaning of accounting. The definition of accounting, it is related to the AICPA, American Institute of Certified Public Accountants. Accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. Before we know the meaning of accounting, what is the exact meaning of account and accountant? The account is refers to the chronological order of financial transactions or related to the business or individuals. This account is a T-shaped form, debit side as well as the credit side. The accountant is a who prepared. The accountant is a trained person to record all the financial transactions of the business organization. He must accurate what are the types of classifications, assets, liabilities, expenses and incomes. This accountant will prepare the financial statements as well as the financial position of the company for a financial particular accounting period. Now coming to the accounting is the process of art of recording. The art of recording is refers to the recording is known as the journal. Journal is a prime of book. All the transactions are recorded in the journal entry at the first time. This journal entry will prepared every month. This journal entry prepared by the date, particulars, ledger folio, debit amount as well as the credit amount. The main purpose of this preparing the journal amount means in any one organization every day lot of transactions related to the small business as well as the large organization. All these transactions are recorded in a chronological order day wise. Then this is the first duty of the accountant. Then art of classification. Classification is refers to the fine book. It is the end of book prepared based on the journal entries. The journal entries prepared day wise. These journal entries are classified into different heads of accounts. For example, purchase account, cash account, furniture account, sales account, Suresh account, Ramesh account, etc. So here heads, each and every head is a separate account under the classification. This classification is also treated as the ledger. After that, it is the art of summarizing. The summarizing means we get some balances in the ledger balances. These balances are shown in the trial balance. This trial balance is not the final statement of the financial accounts. This trial balance we know the what debit as well as the credit items are equal or not. So recording, classifying and summarizing in a significant manner in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. So here in accounting we should record only the monetary transactions. Non-monetary transactions are not recorded in the books of accounts. For example, purchase furniture for cash 5,000 rupees. So this is a transaction. The amount is monetary value 5,000 rupees. Without 5,000 rupees, that transactions are treated as the non-monetary transactions. that transactions are not recorded at any cost in the books of accounts, which are in at least financial character and interpreting the results thereof. After preparing the financial statements, the accountant will prepare the financial statement analysis like funds flow analysis, cash flow analysis, ratio analysis, comparative analysis, common size analysis. These are all of the analysis prepared. Then you have to submit all these files to the authority of the organization. So now accounting concepts as well as the accounting conventions. So today I want to discuss about the accounting concepts. The accounting concept is refers to the term denotes accounting postulates which indicates the basic assumptions as well as the customs upon the science of accounting is based. These accounting concepts are broadly classified into various types. One is business entity concept, money measurement concept, going concern concept, dual aspect concept, periodicity concept, historical cost concept, matching concept, and realization concept. The first one is the business entity concept. The business entity concept is refers to the business unit is separate and distinct from owners. Why? Because the various forms of business organizations are there. Sole trader form of business organization, partnership form of business organization, and joint stock company. In sole trader as well as the partnership form of business organization, is the owner and management both are same. The owner will enjoy the profits. In case of any loss, he only bear the losses. But company's point of view, the owner is different from the management. Why? Because the owner will provide resources to the business as a loan. It treated as a capital. So in every business starting stage, the owner supply some resources to the firm is known as the assets. Later, all total amount supplied to the firm is known as the capital. For example, the proprietor start a business with 50,000 rupees. This 50,000 rupees money is came into the business from the owner. It is a capital of that owner. It is treated as the liability. So here the business entity concept is majorly depends upon the accounting equation. The whole financial accounting is depends on accounting equation. That equation is refers to the assets equals to liabilities plus capital. So here assets means what type of assets are there that organization. Liabilities means who provide the capital to the business. Capital, owners funds is called as the capital. So shows that business owns assets and owes to claimant the decisions. The second concept is the money measurement concept. So money measurement concept is refers to the transactions are recorded in terms of money. According to the AICPA definition, art of recording, classifying and summarizing in a significant manner and in terms of money transactions and events. So all the transactions we have to record only the monetary value or express in monetary way. In accounting, all events and transactions are recorded in terms of money. Money is considered or act as a common denominator. A business unit has the following assets on every end of the year: cash in hand 500 rupees, cash at bank 200 rupees, furniture 500 rupees, building 1000 rupees. So all these are having this some monetary value. Without the monetary value, all these transactions are not recorded in the books of account. So non-monetary events are not recorded in the accounts. Third concept in accounting concepts, going concern concept. The transactions are recorded assuming that the business will exist for a long period of time. A business unit is considered as a going concern, not a liquidated one. The basis for valuing assets at historical as well as the replacement cost. Supports treating prepaid expenses as assets. So these prepaid expenses are related to the already paid. They are treated as the prepaid expenses, treated as the asset side in the balance sheet, which indicates the going concern concept. Business will going for a long period of time. They why? Because the persons will only change, business will continue. Dual aspect concept. Every transaction has two accounts. According to the dual aspect concept, every transaction has two accounts. One is giving certain benefits as well as the receiving certain benefits. So according to the double entry system of bookkeeping, each and every debit amount must equals to the credit amount. So we have to enter a transaction related to the purchasing furniture for cash. This is treated as a transaction worth of 5,000 rupees. In this transaction, we have to identify the two accounts. One is furniture and another one is the cash. Furniture is comes under the assets. All assets are comes under debit. Cash, we purchase the furniture means we will give the cash to cash. So cash is going concept. Cash is also comes under the real account. So both are real account. One is comes in furniture as well as the cash. So here two aspects, one furniture account, debtor to cash account. Based on dual aspect concept, every debit amount must equals to the every credit amount. 5,000 debit side as well as the 5,000 credit side. The main principle of double entry system is every debit amount has equals to the every credit amount. Then periodicity concept. Business life is divided into accounting periods. So generally the accounting period starting from 1st April some year to 31st March. So for example 2005 means that 1st April 2024 to 31st March 2005 is the accounting period. In this accounting period, the business or companies, they declare the results every quarterly or half yearly or semi-quarterly, every 3 months, 6 months, as well as Q1, Q2, Q3, Q4 means financial year. So this business life divided into accounting periods. Income statement shows profit for each year. So this accounting period means we have to prepare the accounting statements. That statement consisting the trading account, profit and loss account as well as the balance sheet. The income statement is also show the how much net profit or net loss gained so particular financial year, particular accounting period. This income statement consisting the debit side all the indirect expenses, credit side all the indirect incomes. For example, debit side and the indirect expenses are salaries, rent, printing, postage, stationery, insurance, advertisement, bad debts. These are all comes under profit and loss account debit side. Coming to the credit side, all the incomes whatever in business, interest received, commission received, dividend received, so all this, then we will get some balance in debit side or credit side. If we will get balance in the debit side, it is treated as the net profit. In case of balance is there in credit side, it is treated as the net loss. Then third one is the balance sheet shows financial position at period end. So this balance sheet is the third statement in the final accounts. It is a statement, it containing the assets as well as the liabilities. What owes to the business, what owns to the business. These two we have to mention in the balance sheet. Historical cost concept. The transactions recorded at original cost. If for example now today I want to take one transaction, means wherever the asset purchase, the certain asset value now I have to consider. Purchased furniture 20,000 rupees in 2010, means now also I include purchase furniture 20,000 rupees in my accounting. Asset recorded at purchase price, later the value reduced by depreciation. Once we will utilize the asset, every year that asset value is reduced by depreciation. Depreciation is nothing but to reduce the value of an fixed asset. This depreciation is calculated in different various. One is a straight line method depreciation, diminishing method depreciation, where methods are there. The main limitation is less relevant under inflation. Matching concept. Costs associated with a period matches with revenues. So cost include here all the debit side of the profit and loss account expenses must match with the all the credit side of the revenues. Once compare these matching the debit side expenses as well as the credit side incomes, then we will match. That is called a matching. Helps to calculate a true net income. Once we compare exact values, then only we know this is the net profit or this is the net loss for the particular financial year. The required adjustments, the outstanding expenses as well as the prepaid expenses also we have to consider. Sometimes we have to add it to the concern expenditure or reduce it from the concern expenditure. Realization concept. The revenue recognized when sale is made. Today I purchase something as well as I sold goods to Ramesh. He immediately I receive the cash, means it is clear. Revenue recognized when sale is made. Ownership and property transferred to buyer. Once I sell goods to XYZ, once I receive the cash, now XYZ is the real owner of that asset. So here two exceptions are there. One is hire purchase as well as the contract. Hire purchase means ownership at last installment, profit on work certified only.